Roku has just released their latest earnings and the stock is down 26% in mere minutes. It's gone from $85 a share to 62, and we're going to be looking at these numbers right now. Then we're going to be looking at my stock valuation spreadsheet to give the fair value of Roku based on these earnings from using discounted free cash flow model and the Buffett-Graham intrinsic value model. This is our case holdings of Roku. As you can see, the price has gone down and the amount of shares Cathie Wood is holding has gone up. Will she be buying? Will she be selling? That is the question that I'm going to answer, and whether or not you should be buying or selling. So let's just get straight into the numbers here. We have the 3 months ended in 21 and 22. And firstly, total net revenue is 764 million, which is less than analyst estimates of 800. So they have not been analyst estimates, and this is why the stock is tanking. So still increasing revenue, from that previous quarter, 645 to 764. And even on the 6 months ended, it's gone up 1.2 to 1.5 billion. So it is growing, but it hasn't beat analyst estimates. Now, why is this important? Well, the cost of revenue is up 100 million. Total gross profit is up slightly. But if we look at the research and development, up massively. Sales and marketing more than doubled. General admin up, so you can see it's gone from 269 million to 465, and this puts the the net income at a loss, 73 million to minus 112, and this is why the market has reacted so poorly. Let me just see if there's been any updates. It's still at 26% down, $62.80 a share. If we just go to the year chart, this basically undoes not all the gains from the 2020, well, pretty much actually. So we're going back to April of 2020 when the stock was at this price. This has been a crazy run up and a crazy drop down. What is that? 82%, and that doesn't include the new drop. Well, that is absolutely madness. But let's continue on. So as I said before, gone from profit to negative. Net income loss per share, 55 cents down to minus 82 cents a share. Are they buying back their shares? Are they issuing more shares? They're issuing more shares, 132 million to 136. Now, normally this is bad because they're diluting the shareholders, but when your stock price has gone from, what is that, $428, if you're issuing more shares at that point, then obviously it's been a good bit of business for you. So because the stock price has dropped, it's worked out quite nicely for them. They've been able to raise capital, reinvest in the business, but unfortunately they have not met analyst estimates, and the stock price is dropping because of that. Next, we want to look at the free cash flow. So we can use this in our calculations, but we've got negative net income, and I'll just go straight to the line. What is free cash flow? It's cash from operating activities minus capex. Operating activities, 144 million to the positive to minus 9.9 in the negative, and capex is up massively. 13.8 is now 52.2. Capex is up massively as well. So let me just go to my valuation spreadsheet here. We've got everything. We've got analyst target price 77 on the lower side. Well, Roku is below that, so analysts have got this wrong. And on the high side, this time in 12 months, could be $205 a share. I'm sure people will be very happy if it got to that. We have the revenue, free cash flow, and net income. These are the previous years. This is the trailing 12 months, not including the most recent numbers. That is what I've added in here. So the trailing 12 months, 3 billion. Net income is now negative, and the free cash flow is 22 million, very, very low. So let's go to my valuation spreadsheet. I was just doing my Apple video, so check that out if you're interested. But we are talking about, sorry, not Apple, that isn't out yet, Amazon. Okay, so what are we looking at here? Well, based on free cash flow estimates, based on my sheet, because of the minuses, it's currently got it estimated at 8 cents a share, so that is a 99% discount. I don't think that number is entirely true. Let's go look at the averages a bit more. I think the revenue growth rate's fine. The net income margin, it's hard to value because they've gone the negative with these years. So discounted free cash flow hates the stock. Let's look at the Buffett-Graham intrinsic value. Obviously, earnings per share is negative. It's going to hit the stock as well. But let's just see what analysts are expecting the growth rate to be. 43%. I mean, that is massive, massive growth. I said that Amazon was very high with 27. That was my previous one. But because it's a negative, it doesn't count. So let me just put in some numbers here. Let's say the earnings was 10 cents a share. That would be $9. $1 a share. If they got to that, they would be fairly valued at their previous price. Obviously, they've dropped down since then. So they would probably need to get to about, what, 70 cents a share, if I could learn how to type here. 68, and that is currently 62. So for this company to turn around, they need to be profitable, and that is what we would need to see from them to do this. So, that's everything. Right, guys, thanks for watching. Please give a like on the video if you enjoyed it. Subscribe. Check out my Amazon video, and the Apple one is coming out as soon as they do their releases. Catch you guys next time.